Good morning, everyone. I'm Joe Bruzzesi. I'm a general partner at Raptor Digital, which is an early stage venture capital fund that I'm building with the Raptor Group, which is the third most active family office in the US right now. I'm really excited about this panel because this is a topic that I think is a hot topic in crypto right now. Everything relating to, are tokens losing their value relative to equity? So I just want to start off with a few areas that I think are really interesting. If you look at what happened with the Cross recently, it's converted its DAO into a C Corp, giving people a 1-for-1 token for equity swap. Uniswap recently, flipped on their fee switch. It looks a lot more like equity than it does like a traditional governance token. And according to Pantera, the average token, Bitcoin, Ethereum, Solana removed was down 80% last year. So with that, I want to flip it over to our panelists, and maybe we could start with just 45 seconds for each of you. Who are you? What do you do? And just for now, yes or no, do you think tokens are losing their structural advantage over equity?
Yeah, of course. Hey, good morning, everyone. James Newman, managing partner and fund manager at Republic, where I run our flagship venture fund. I'm also European CEO. For those who don't know what Republic is, it's a global infrastructure and investment platform that looks to democratize access to private market investments via tokenization.
Rob Schmults, I'm a general partner at Blockchange Ventures. We're early stage venture capital focused on the blockchain. We've been investing in the space for about 9 years.
Johnny Garcia, I lead our institutional growth efforts at the VeChain Foundation. Actually, I'm gonna answer your question directly here in a few seconds. But I prior to VeChain, I had worked at Bitwise Asset Management, where I led ETF, ETP capital markets. So essentially sitting on the other side of the aisle, convincing institutions why the best way and method through which you should achieve crypto exposure was through ETF, ETP, traditional equity, securitized wrappers. My direct answer to you, though, Joe, is no.
Jean?
My answer is yes. But I'm Jean-Marie Mognetti. I'm the CEO and co-founder of CoinShares. CoinShares is the largest European digital asset management company specializing in digital assets. And to your question, Joe, yes, I think the advantage is collapsing fast. And what we're seeing right now is a repricing of risk.
All right, well, I'm excited to go deeper with you on that. So I want to start with Rob. I've got a few direct questions for each of you. Rob, Blockchange is one of the best funds in the space. I know you guys were early in Solana. You've done equity deals like Figure, Denari. You've done other token deals as well. In a world where, maybe tokens are losing their value relative to equity as a fundraising method, what's changed in the term sheets, the discussions? What's changed in your portfolio construction? How do you think about equity versus tokens right now?
Yeah, so we've, back when everyone was sort of, token, we were fine doing equity. And I would say now we're still fine doing token, but in both cases, in either case, there has to be a rationale for the structure. I think our most common model, and this has been true for years, has been an equity investment with a token warrant. Even if the team says, we're never doing a token, they might change their mind. It just simplifies everything to have the token warrant in there. So we're still doing token warrants today, even if the team isn't planning on it as part of their structure. I think our view on sort of tokens long term, people like analogies. I think by way of analogy, we may be in our sort of .com moment where what happened during the .com bubble bursting was not that the IPO ended for all time. It just became apparent that there were a number of companies that had entered the public market that didn't have the necessary attributes and underlying business to support being a public entity. And so I think in the same way, we probably have a lot of companies that have a liquid token that maybe, as some of us were discussing before the panel, it maybe never should have, right? You can't blame them. With hindsight, it's clear that they probably shouldn't have done a TGE, but at the time it made total sense because it was almost free money. And so I think that long term, tokens may come back in the same way IPOs came back for quote unquote .com companies, just they were more advanced, a more substantive business underneath the hood that allowed them to actually be a public entity. Does that make sense?
It does, and I want to go to James next to talk about some of the things they're doing with tokenization, which are different. But I guess as a quick follow-up for tokens right now, for things that are not equity representations on chain, do you guys have a framework how to think about where does the value for a token that's not equity come from?
Yeah, I mean, there has to be something really substantive under the hood, right? So it's a little easier for an equity bet to sort of say, all right, if then, if there's a TG on the horizon, I think everyone's very right to be nervous as to, well, is this just going to do what's been typical, go out the door and then fall? We actually, I mean, it's not noticed as much. We've had some recent TGs that have done fine. So we did a token only deal. We actually invested in it twice called ETH Gas. They're token only, and I hate to jinx anything, but their token's been performing pretty well, at least last time I looked.
That's awesome. All right. Well, James, I want to talk about some of the things you're doing at Republic with mirror tokens, contingent payout notes. Effectively, you're tokenizing outcomes in companies like TikTok, Anthropic, et cetera. So can you talk a little bit about what those are and how you think about, is tokenization really just becoming a wrapper for what's underneath or claims on real things? So maybe you could talk to us a bit about mirror tokens and some of the things you're working on there.
Thank you. I think the real kind of question around this is where the legal and economic right lives and whether that should be on or off chain. And at Republic, we're pretty deliberate about this, depending on the structure. And obviously, there's some financial engineering regarding some of mirror tokens, SPVs, etc. I think fundamentally, the large institutional type investors want to have clarity about what they own and the legal and regulatory rights on this. So in many respects, some things can be related to kind of shadow tokens or reverse ledgers, etc. And that makes sense. And in terms of native issuance, as in going forward, I think that's something that we have been exploring pretty extensively. It's something that we're going to be looking at more in the future. But for the time being, people want digital representation with the right legal and economic rights, which arguably at the moment tend to be off-chain.
Okay, Johnny, I want to go to you now because, I was looking into your background before this panel. You've obviously been at Vanguard, you've been at Bitwise. In your most recent role, you were convincing people they should own crypto through an equity or through a wrapper. You're now at VeChain, and I think it's a different perspective. You're probably convincing institutions they have to hold or use your token. I saw you guys have clients like BMW, Walmart, BYD, really big names. And so I guess my first question for you is, does the public token actually do anything for these institutions? And I think more broadly, could you do something on a permission blockchain with no token for the same clients? And A, would they notice? And B, do they really care about it?
Now, the answer to that question is yes, for the following reason. So I can give a little bit of background here on VeChain. VeChain was birthed out of the idea of being focused primarily on B2B enterprise-related blockchain as a service solution. We've since evolved in the last 2 years to now extend that said offering to also a B2C-like model. So think consumer-based applications that are now launched within our DAO ecosystem that then can now interact not only with businesses, but also with consumers from the perspective of consumer engagement, consumer loyalty programs, reward programs of that like. Now, more specific to your question of like the value of a token, I think the question here is a little bit of a non sequitur, right? So what precipitates this is how are you approaching a token to begin with? Now, the conversations I was having around an ETF was purely from the perspective of how to gain exposure to a high vol asset. The conversations I'm having now are very different. The use of a token is very different than approaching a token from the perspective of holding it with expectations of return value. And that, I think, creates a very different type of conversation that you're having with the audience or with the end user. So from my perspective, equities are actually, those examples that you mentioned, Joe, I think illuminate some structural limitations of equity. Form factor matters a lot, right? Tokens can be used for gas consumption. They can be used for reward mechanisms. You cannot stake an ETF and secure a network and generate yields. You cannot, or an equity for that matter. You cannot, equity does not have a programmatic process via smart contracts through which it can incorporate buyback like mechanisms or programs, right? Those are board level decisions. I acknowledge that this is probably a hill I'm not going to die on today, governance tokens, which is a separate argument, but tokens have multiple form factors. They're multifaceted. And I think an honest and intellectual debate would take that into consideration.
All right. I like it. So Jean, in December, I saw you published your 2026 outlook, and I'm going to look at my phone quickly. But for your framework that you're calling hybrid finance, when I look through it, obviously some of the big points, hyperliquid, 3 trillion in volume. Aave has, TVL that might compete with some mid to large banks in the US. BlackRock and JP Morgan are entering this space. So you're describing a world where, token-based protocols, asset managers, and incumbent financial institutions are kind of all building in the same rails. So can you walk us through that hybrid finance thesis and then maybe kind of apply it where this panel sits? Like when you look at the data points in your own report, what's actually happening between, distinguishing between a token and an equity claim?
Yeah, if we wind back the clock a little bit and we go back to 2017 September when the very first ICO started to happen, which were kind of the nascence of the token movement, and all these tokens were creating around a problem which was called the Howey test. Say, okay, how do I circumvent effectively something called Howey test in the US, which is basically a test to decide whether you are a security or not. And most of these protocols, because they were issuing outside of the traditional issuance process, were trying to find a way effectively to not fall within the test, which creates in a lot of imagination, a lot of, I would say, program where people were inventing tokens with some kind of utility function, which were baffling for a lot of economists, but which were still apparently very much attractive for retail investors. And so we saw this kind of, in a very simple terms, rotation out of Bitcoin and Ethereum into a lot of tokens. And now you get like a ton of tokens available. 99% of them probably goes to zero. But they were available for a very, very long time. And they were here because there was an absence of regulation, absence of framework, and the technology was still very powerful. And what is important here to differentiate is like the difference between what we do with the technology and the kind of like terminology we use. And there is no discussion that the blockchain technology, the scripting capacity attached to it, is very powerful to issue any kind of contract for, what you were discussing, Johnny, about, just tokenization of bets, tokenization of effectively prediction market is very powerful on that nature, but don't really work very well as an ETF. We have all this ETF filing for prediction market. Now you wonder how does that work very, very well, but that works extremely well in the token concept because the token concept is extremely good at fast tracking and turbocharging distribution. And so the old thesis we're having is like to say, okay, a token has been living their own life for a while on the side because there was an absence of regulation. Equity, story, bond, and the traditional finance has been living their life on the other side. And then the same way as regulation starting to converge, we'll see it already in Europe, where the convergence is pretty obvious, saving for a few letters. We're going to get a convergence as well in the US, where eventually everything going to be regulated more or less in a way which is, not always similar. Don't forget that the electronification of the stock market is 1970, so there's plenty of update to be done there. And so what we're trying to figure out is how tokens and tokens in general and blockchain technology is contributing to the upgrade of the greater financial system, where the thesis have been a bit updated since we published in December, and we published an update on Friday. It's like on the back of everything which happened over the last quarter in DeFi, where you get this kind of series of hacks, series of honeypots, which are left in the code for some people to be maliciously having bad acts on this territory. And what we tend to see effectively is a complete repricing of risk, because people were thinking all this stuff is completely safe, and all of a sudden you realize, well, actually, is it really that safe? And Mythos from Anthropic is like showing even more capacity to discover this kind of weaknesses which are available. So the way we are seeing it evolving more and more, and this hybrid finance concept is really, the rails are being built to the technology, and all the firms we're mentioning, or all the firm you were mentioning, Joe, which are coming from traditional finance, are bringing this layer of trust and credibility. Because right now, what is happening is like it's very well being to be decentralized. Question is what decentralized means, and that's probably your next topic. But beyond the decentralization itself is like, okay, well, once the sea is not calm and there is a real problem, decentralization goes away and nobody's accountable but the retail. And the retail audience becomes a social loss factor where everything goes through. And it has been the story of this token since the very beginning. You look at the very, very first ICO, you look at the very first few scandals like Sushi Swap and Pancake Swap and names which were, or even like Bitcoin Jesus, which was the very first kind of one of the very first fork on Bitcoin. It has always been at the mercy and at the expense of the retail user. And so there's a bit of accountability, a bit of stewardship, a bit of fiduciary duty which needs to be injected in this tokenization. And the only way tokenization scale if this fiduciary duty is injected. So what's the real, the people with the big pockets can start deploying real capital at scale.
So that does lead me to, so we're about halfway through this panel, and I knew we had such a good group of guys up here today, and so what I thought I would do, and I want to say for the record, like, I don't necessarily believe the statements I'm about to make, but I'm making them only for the point of like getting a great intellectual debate up here. So I'm just going to read a few statements, and I'd love for each of you guys to say, do you agree? Do you disagree? And then, we could have a bigger conversation among the panel. So I'm going to start with decentralization because that is what I want to talk about. So the statement is, decentralization as a product feature has negative commercial value in 2026. Customers don't pay for it. Regulators no longer require the theater of it, and founders are routing around it. We see a lot of examples of this, I think. The only people selling decentralization are the ones who already sold tokens. Do you guys agree or disagree? And then happy to have debate among the panel.
I'll go first. Not negative, but it's certainly diminished. Just in the same way that if we think about, one sec. Actually, the way that I think about it is that decentralization needs to be a feature. It needs to be a product feature. It can't be anything other than that. So by product feature, it needs to be a design choice. And by design choice, it has to be incorporated into something that has commercial product or market structure advantages. So I would say that, no, it's not, it hasn't disappeared, but it's certainly diminished.
Totally agree with James. And I just add to that every new tech, ends get confused with means, and decentralization became an end in of itself. And I just piling on to what you said, it's got to be a means to something, not a goal, full stop, unto itself. So I like the way you phrased it. It's a product feature. It's a piece of a solution, not just a thing that's good inherently.
Johnny, what do you
I'm actually
think?
quite surprised. So I agree both with Rob and James. I wasn't sure what your response was going to be. I was a little hesitant because I thought, oh man, I'm going to have to figure out how do I dodge this one. No, but I do think that decentralization as I guess a select marketing choice is probably not the best ROI decision. It has to be designed, a part of the design, right? So from our perspective, if I were to sort of decompose it to the sum of its parts, I think the most important component of it is credible neutrality. So you asked me a question earlier about why not just do permissioned versus permissionless. Well, Walmart did not select VeChain because of its token, right? It selected it because it has a credibly neutral chain. And part of that is a function. It's a direct byproduct of decentralization. Whereas they don't need to trust VeChain, they don't need to trust other vendors. They don't have to be subject to vendor lock-in or bilateral agreements or other issues that are pervasive with permission chains, custom integrations. These are incredibly costly. Decentralization is a form factor of, or a byproduct of, credible neutrality, and that's what I think is the most important part of decentralization. It's not a marketing term; it is a feature.
Sean?
Yeah, I think true decentralization works, and we saw the Bitcoin, and the Bitcoin network is a perfect example of that. Decentralization as a gimmick doesn't work. So decentralization will work with governance. We saw it again with the Bitcoin network. Some people would say it's too complicated, but it works. Decentralization on all the network doesn't work. So it can't be just an attribute of a pitch deck for VCs. It needs to be a real technical choice, which can be backed up by evidence.
All right, let's do the next one. And I think it was interesting. If you look at the Pantera report, talking about tokens are down on average 80%. Crypto equities actually were way outperforming tokens last year. So stablecoins are a $300 billion business that produces $0 of value for any protocol token holder anywhere. The biggest crypto success story of the last 5 years was actually an equity story. Circle, Tether's $500 billion supposed valuation, Stripe acquiring Bridge for $1.1 billion. That's not really an exception. That's actually the template going forward. Agree or disagree?
I'm going to disagree. And I'll use another analogy from the internet. If it was 1994, we could be being asked that same question about email. Is email the killer app for the internet? And at that point, the answer was yes. But thankfully, founders and investors didn't say, all right, well, we're done here. Let's go find the next thing, right? All the value is still to come. And so I think we could see something that kind of rhymes with that, where stablecoins break into the broader world of founders and the public and institutions. And then they discover the other things about blockchain that are amazing, and other applications flow as a result. So I think that's hopefully where we're headed.
And we still have postal. Yeah, we still have postal, but there's been multiple derivatives of email since, right? Messaging apps, things of that nature.
Yeah, and well, I just mean the whole internet. People didn't say, "Oh, we're done here," right? Internet's just email. The best was still yet to come in many ways.
But I guess like to just double click on this a little bit. So stablecoins are a huge business. Lots of money has been made by people who own equity in stablecoin companies. All of that value is being created on the underlying blockchain rails where these things live and transact and get sent. If you look at all the new chains that are coming out, the pitch is like, oh, it's 0.001 cents to send a stablecoin. And you have all these people that own these tokens that are saying, hey, it's a good token to own because look how much stablecoin activity is on this chain. So do you think like the underlying activity on these networks, let's just say from stablecoins, is actually creating value only for the equity holders and the issuers? Or do you actually think it's creating a lot of value for the underlying protocols, their governance and utility tokens?
No.
Yeah, I mean,
So eventually it create value for the protocol. If you look at the Clarity Act in June, July last year, there was a penny drop moment. Then people realized that, oh, we have a law now, we have a regulation, and now we hit the blockchain. And all of a sudden you see Ethereum, which was kind of like, languishing in the laws of the laws, having a second lease of life, because people are realizing that, okay, you need a network which is large enough, decentralized in some sense, and which can carry the weight and with some kind of architectural plan for the future. And so there is some future for protocol which can scale and can support this traffic. To go back to your point about stablecoin issuer, they are issuers. They are, to the most degree, as transparent as they can be. There is some governance, there is some process around that, and they scale as a result. And the reason why they are the business which are successful now, because they are one of the very few business which can scale at a global level. And so obviously the kind of impact is much bigger. But as James was saying, there will be new one coming after that, because this is innovation once after all. And what's happening through stablecoin right now, which are solving a real world issue. We are fortunate enough in the US to have a banking system which works approximately well compared to how it works in LATAM or Southeast Asia. So we don't really appreciate the champagne problem we are solving for Westerner, but there is a real use and a real need for it. And so this is solving a real daily issue for people, and that's why it's scaling.
All right. Oh, go ahead, James.
I was just going to say, more broadly from kind of an investing standpoint, it's the question of like where value accrues to, whether it's to the equity, to the token, to the network, to the governance, etc. I think stablecoins are they're in a unique space where regulatory capital, centralization makes a lot of sense that the value accretes to the equity rather than to any kind of token utility.
Okay. Listen, we have 5 minutes left, and I have 2 questions for each of you. What I want to start with, and we'll just go down the line, maybe James, starting with you. Name one piece of conventional wisdom in this industry, something that's widely repeated, something that's said on stages like this one or others, and something maybe taken for granted in your group chats that you think is dead wrong.
Just because you put something on chain makes it more investable.
That's a good one. Just because you qualify with right now, so I reserve the right to change my mind in a year or whenever, agents will need their own financial rails. I'm not sure I buy that. Not right now.
I want to just double click on this for a second. We have limited time, but everyone in the space is talking about this. I mean, it's amazing. You read every day there's a new fund launch. It's about agentic payments. Does anyone have a firm opinion whether agents actually need the blockchain? Like a lot of people will say like agents can't have bank accounts. Agents can't be KYC'd. They're not going to use cash. They're only going to use crypto. This is a big narrative in the space, and I feel like maybe you're taking the short side of it. How do you think
again,
about
to a degree. So I think there is a role for blockchain. I'm not saying there's no role for blockchain, but I just, if you think about an agent inherently, it's your agent. It's an extension of you or your company. And therefore, if you choose to give it, it has access to your wallet, your APIs, your et cetera, for payments. So we may get to some point where the use case is, oh my gosh, the agent needs its own rails because they fundamentally don't work. But I think there's such a diversity of rails that we haven't really fully even explored yet, and because we don't have the use cases yet. And if you look at the owners of the rails, Visa, Stripe, you name it, they're all saying, yes, we are setting up for micropayments, we're setting up for agentic transactions. And so that's why I'm skeptical that there might be a completely new parallel financial system just for agents. I'm just not sure I buy that right now.
That's a good hot take, by the way. I like it. All right, Johnny, how about you?
Back away in Joe. The only comment I was going to make is I feel like the payments narrative has gotten well advanced of the actual reality. Where I do think a really interesting place will manifest is identification. So how we solve that, our view is that we think blockchain is the preferred partner of choice ad infinitum until death do AI and blockchain apart.
All right. Well, so separate of that, I guess. So what about you? Like, what do you think is like conventional wisdom in this space? Things people are talking about that you don't agree with?
Yeah, I'll flip this one on its head. That institutional adoption is buying and holding tokens. Now, institutional adoption is going to be when folks issue their own representative tokens on chain and are using the actual blockchain in a way that's orders of magnitude better than how they're contemplating and conceptualizing it at present.
I appreciate you guys are doing that good work, by the way, because somebody has to. Jean, how about you?
Two things. One, that you can rebuild finance on chain without accountability and fiduciary duty. That's kind of a critical point. Second point, that tokenization is solving all the problem, and that tokenization is not solving, tokenization doesn't solve liquidity, doesn't solve price discovery. So you can tokenize Hudson Yard. That's not going to increase the velocity of the transaction. You still have the same question around price discovery.
All right, so I have one last question that we'll end it with. And I think about all the time, like this space has been so full of narratives, NFTs, meme coins, metaverse land in the clouds, digital asset treasuries. And if you kind of look back at a lot of these in hindsight, you could see like maybe why they didn't work. One thing we all talk about what we think is going to happen in the future, but what I'd love to know is what's a position you held very firmly 2 years ago that you no longer hold today and why? Jean, we'll start with you. And this is the last question.
It's echoing very much what we said, like that decentralization can sort out everything, and actually it doesn't.
Johnny?
That tokens hold no value. And now I'm a firm believer that they actually do. It just depends on the sum of its parts, and you have to be able to clearly articulate that.
Rob?
Just because I've been wrong for 2 years, but hopefully I'll be right eventually, that we'll get more decentralized market models where you take out the sort of centralized intermediary. I think there's still a lot of markets where we can have a lot of value from the blockchain taking out cost and friction, but I have not seen the flood of them as I expected.
All right, James, wrap it up for us.
That tokens are one of the best conduits for crypto financing.
All right, guys. Well, listen, you're all doing great work in the space, so thanks for everything you do. I think this was a good panel, so thank you, guys.
Thanks.